We've just held Argo Infrastructure's 2025 annual general meeting, and I'm joined now by our Managing Director, Jason Beddow, to discuss the company, global listed infrastructure more broadly, and the outlook for the asset class. Jason, I wanted to start by talking about the wild swings that we've seen on markets over the last year. A lot of this has been driven by pretty major geopolitical issues, not least of all some tariff announcements. How has global listed infrastructure performed against this backdrop?
As an asset class, it's been rock solid. I guess one of the reasons we've always liked infrastructure is, they're essential services. These are largely fixed assets, and for a lot of the time, they're not impacted really by the economy, interest rates, and so look, they're very local, and tariffs have very little impact. Now, look, there are some subsectors, marine ports with trade, potentially railways, but I'd say the large majority of infrastructure, the business models themselves. Now, the share prices have moved around a little bit, but I would think over the course of the year, as you're saying, with the volatility, the share prices have been much more benign, but the earnings they're generating have barely moved.
And could you just go into a little bit more about why global listed infrastructure performs this way during periods of uncertainty?
Oh, I think it's a safe haven. I think investors, Australian investors particularly, who are very familiar with the asset class, realise that the cash flows that they generate are very stable. The distributions they're paying to shareholders is also very stable. And the business models themselves are really not at risk, as I say, apart from those very pointed ends that may be trade impacted. I guess in that time, we've seen Cohen and Steers pivot the portfolio away from those areas, which is their job, I guess, in why they're the manager. But they have that flexibility. If there are some subsectors or potential geographies that they are attracted to or equally cautious of, they can move the portfolio to adjust for that.
And all signs are now pointing to another interest rate cut by the US Federal Reserve. The second this year follows two last year, after a period of very steep interest rate increases. What does the latest monetary easing cycle mean for the asset class?
Typically, it's positive. Two reasons generally. Like infrastructure, because it's so stable with the earnings, they do carry a lot of debt by, I guess, industrial company standards. And while they have some hedging in place and it's termed out over, quite often 7 to 10 years, they certainly get a benefit of lower interest costs through their P&L and I guess, for shareholders. Secondly, I guess if you're just doing basic valuation on cost of capital, if the cost of debt goes down, your valuation on paper at least goes up. So they get a real win with lower interest costs, and I guess they get a more intangible benefit from a valuation perspective.
And if inflation starts to take off again, what's the impact on the asset class?
Well, it'll be twofold, I guess. A lot of businesses have inflation in their revenues, so they are inflation protected, which is great from a revenue perspective. Again, I guess if interest rates go up far enough and long enough, they would have some additional interest costs. There's a bit of a headwind, and arguably you could argue the valuations with the extra cost of debt could come down a little. But we think over time they're a net beneficiary. When having this revenue linked to inflation, when you go through periods like we did on the back end of COVID, where inflation really were levels we hadn't seen for decades, most of these companies captured that in their revenues.
And we're seeing investment market headlines being dominated by this massive investment boom in AI. Can you get any exposure to this boom through global listed infrastructure?
Yes, certainly. I mean, there's the data centers themselves. I mean, they are, I guess, digital infrastructure and certainly qualify for how we would define infrastructure. Probably in an easier way, though, or a more tangible way is these data centers have a huge electricity demands. So there's the generation to power them, but also equally the transmission of getting the power to them, but equally to get the data away. So there's quite a lot of investment when a data center goes in. And I guess currently they're trying to build them where there is existing power. But that's running out very quickly. So there's a lot of investment in the whole supply chain of a data center. So I think there's plenty of opportunities, and it's a global phenomenon as well. This is not just US-centric. Clearly the majority of investment is there, but every country or particularly Western economy, is investing in data centres.
And what other trends are shaping the asset class at the moment in terms of the medium to longer term outlook?
Look, I think some are consistent from when we, put Argo Infrastructure together. There's demands from emerging economies to modernise and have infrastructure. There's a lot of old infrastructure that needs renewing. I think Australia is a great example of the benefits of privatisation when at the right time and the right price, clearly. But governments are very cash strapped, and if you can build and then sell off good infrastructure into private hands who can get fair returns, the public and the economy generally benefits, and the government can redeploy this money. So I think those are still there. I guess we've got a bit of a supercharge now with AI and data centres and the power demand. Some of the stats that CNS quote, and it's very similar in Australia. I mean, we've had flat power demand for 20, 30 years because of, I guess, LED lighting and efficiencies and a lot of things. And electricity demand is accelerating again now with all this new demand. So there's plenty of demand for new infrastructure.
And CNS, as you refer to, is Cohen & Steers, our portfolio
Correct.
manager. This year we marked 10 years since Argo Infrastructure was listed on the ASX. I wanted you to reflect on that decade, but first, could you just explain the rationale for establishing Argo Global Listed Infrastructure?
Certainly. Look, as I guess Australia, and I've touched on this, was at the forefront of infrastructure assets in private hands. We had a large number of stocks in the ASX, and some they're very successful, Sydney Airport and others. A large number have been taken over or privatised by global pension funds or others who saw value that well above what the market was paying. So if you like that defensive part in your portfolio and the dividend growth, there's really not many opportunities. As a global universe, there's 350 and growing companies that qualify, and probably more across the whole world. And we think, wow, that's a really interesting universe to have access to. As an Australian manager of money, we realised that to do it well, you probably wanted a global manager who was an expert in the space, but also had global resources. So Cohen & Steers, after looking at what our options were a perfect fit. They're a very large global manager of real assets, including infrastructure, real estate, and commodities, over $100 billion US. The parent company, Cohen & Steers, is listed on the New York Stock Exchange, very similar to Argo, so you get good governance, good risk adjustment. So it ticked a lot of boxes, and I guess ultimately they've had really good returns. So we thought offering that to Australian investors who had shown a great propensity to invest in these stocks and were no longer able to, in a LIC structure, which made it very easy: buy one stock, get exposure to the whole universe, provide currently, but franking credits as well in that corporate structure, would be attractive, and I think it's delivered largely as we'd hoped.
Thanks very much, Jason, and thanks to all our shareholders who joined us for today's annual general meeting. We look forward to seeing you next year when we hold our national roadshow.